Hello fellow traders. Today is another of many videos where we cover things in the markets. Today we cover understanding market cycles and trends by a Pajama Trader. Market cycles and trends. Understanding cyclical nature. Markets move at predictable patterns, alternating between periods of growth and contradiction. Identifying these trend cycles is crucial for informed decision making. Phases of the market cycle. We'll delve into four key phases: accumulation, markup, distribution, and markdown, exploring investor behavior and price movements in each. Trend analysis. Moving beyond cycles. We'll examine longer-term trends shaping specific markets and industries, uncovering potential opportunities and challenges. Impact on investment strategies. We'll translate cycle and trends insights into actionable strategies, help you navigate market fluctuations, and optimize your portfolio. Real-world examples. We'll showcase historical and current market cycles and trends across various sectors, illustrating their practical implications. Looking ahead, we'll conclude by discussing anticipated future trends and their potential impact on the markets, equipping you with informed foresight. What are market cycles? Recurring patterns. Market cycles described as natural ups and downs of financial markets over time. They reflect changes in investor sentiment, economic conditions, and other factors. Three key phases. Bull market. A period of sustained price increases in asset values driven by optimism and strong economic performance. Think of it as a rising tide lifting all boats. Bear market. A period of prolonged price declines, often triggered by fear or negative economic events. Imagine choppy waters of investors seeking safe harbor. Correction. A temporary, often sharp downward price movement within a large bull market. It's like a dip in the roller coaster before the climb continues. Understanding cycles. Recognizing these phases empowers investors to make informed decisions about buying, selling, and holding assets. Bull market phase. Rising asset prices. Sustained increase in stock prices, typically 20% or more over a 2-month period across major indices like the S&P 500 or Dow Jones. Investor optimism. High confidence in the market's future performance, driving increased buying and holding of stocks. Strong economic backdrop. Low unemployment, healthy corporate profits, and positive economic indicators like GDP growth often accompany bull markets. Increased market activity. Higher trading volume and broader participation from investors seeking to capitalize on the upward trend. Historical examples. The 90s dot-com boom, 1995 to 2000. Fueled by the rise of the internet and tech companies, this bull market saw the S&P triple in value. Post-recession bull run, 2009 to 2019. Following 2008 financial crisis, the extended bull market witnessed a steady economic recovery and stock prices reaching record highs. Contributing factors. Positive economic indicators. Low interest rates, rising wages, stable inflation create an environment conducive to business growth and investor confidence. Strong corporate earnings. Companies exceeding profit expectations can boost their investor sentiment and drive stock prices higher. Technological advancements. Breakthroughs in technology can open up new industries and investment opportunities, fueling market optimism. Government policies. Tax cuts, infrastructure spending, supportive regulatory measures can stimulate economic activity and benefit certain sectors. Bear market phase. Falling asset prices. Sustained decline in stock prices, typically 20% or more over a 2-month period of time across major indices. Investor pessimism. Fear and lack of confidence in the market's future, leading to increased selling and reduced buying activity. Weak economic conditions. Recession. High unemployment. Declining corporate profits and negative economic indicators often accompany bear markets. Increased market volatility. Sharp price swings and unpredictable trading patterns become more common. Examples of past bear markets. Great Depression, 1929 to 1933. Triggered by the stock market crash of 1929, this prolonged bear market resulted in an 89% decline in the S&P 500 and widespread economic hardship. Global financial crisis, 2007 to 2008. The collapse of the housing market led to severe downturn in the global economy, with the S&P 500 falling over 50% in less than a year. Factors leading to a bearish trend. Economic recession. A significant decline in economic activity can lead to decreased corporate profits, rising unemployment, and investor panic, triggering a bear market. Declining corporate earnings. When companies consistently miss profit expectations, it can erode investors' confidence and trigger selling pressure. Financial market bubbles. Unsustainable asset price growth driven by speculation can eventually burst, leading to a sharp correction and potentially a bear market. Geopolitical events, wars, political instability, and other major events can create uncertainty and risk aversion, leading to investors to pull out of the market. Correction phase. A temporary, often sharp downward price movement within a larger bull market. Corrections typically range from 5 to 10% declines, but can occasionally be deeper. Think of it as a pause or breather during the market's upward climb, not a complete reversal of the trend. Role in healthy cycles. Prevent overheating. Corrections release built-up investor euphoria and prevent unsustainable bubbles from forming. Shake out weak hands. Nervous investors who sell during corrections leave the market for steadier hands, leading to stronger long-term commitment. Create buying opportunities. Temporary dips offer seekers attractive entry points for undervalued stocks. Triggering factors. Overvaluation. When asset prices rise beyond their perceived intrinsic value, a correction can adjust them back to equilibrium. Profit taking. Investors who accumulate gains during bull markets may choose to sell a portion of their holdings, leading to a temporary price drop. External events. Sudden news or events like interest rate hikes, geopolitical issues, or natural disasters can trigger short-term market reactions. Remember, corrections are a natural part of the market cycle and shouldn't be interpreted as the end of a bull market. Understanding their triggers and role can help investors stay calm and make informed decisions during these temporary downturns. Market cycle illustration. Imagine a mountain range. Upward slopes representing bull markets, downward slopes representing bear markets, and plateaus represent corrections. Bull market. A steady rising slope often depicted with vibrant green lines or arrows indicating upward movement. Bear market. A steep downward slope often shown with red lines or arrows suggesting declining prices. And corrections. A temporary dip within the bull market, visualized as a brief downward curve before resuming the upward climb. The importance of recognizing phases. Bull market. Time to capitalize on growth, potentially increase investment exposure, and focus on long-term strategies. In bear markets, time for risk management, consider portfolio adjustments, and potentially adopt defensive strategies. Correction markets. Opportunity for strategic buying of undervalued stocks or rebalancing of portfolios without drastic changes. The benefits of understanding. Informed investment decisions. Aligning strategies with current market phases can help improve returns and mitigate potential losses. Emotional control. Recognizing temporary corrections within the bull market can prevent panic selling and missed opportunities. Realistic expectations. Understanding the cyclical nature of markets help manages expectations and avoid chasing unsustainable trends. Let's help other traders change their trading game by giving this video a like and sharing with other like-minded people and possibly subscribing for more information like this. Here's a quick look of the historical trends. On the left, you see where things were, and on the right, you see where we are now. And all of that red, to me, looks like a car going uphill running out of gas. Eventually, it's going to turn around and get to these lower levels that you see on the left. Historical trends. Economic data releases. Job reports. Strong economic numbers generally boost investor confidence, potentially leading to rising stock prices. Conversely, weak reports can trigger anxiety and market downturns. Interest rate decisions. Central bank adjustments to interest rates can significantly impact various sectors. Lower interest rates often benefit growth stocks, while higher rates favor value stocks and financial institutions. Inflation data. Rising inflation can erode corporate profits and consumer spending, potentially leading to market volatility and sector shifts. Stable or falling inflation typically indicates a healthy economic environment and potentially supports market stability. Technological advancements. Breakthrough innovations. Major technological breakthroughs in sectors like AI, biotechnology, or renewable energy can spark excitement and investment in those areas, driving market trends within related companies and industries. Industry disruptions. New technologies can also disrupt existing industries, potentially leading to declines in established companies and growth opportunities for innovative players, impacting market trends accordingly. Geopolitical events. Trade wars and international conflicts. Disruptions in global trade or major geopolitical conflicts can create uncertainty and risk aversion, potentially leading to market downturns, especially in affected sectors. Political elections and policy changes. Major policy shifts or election outcomes can impact specific industries and sectors, influencing market trends in those areas. Natural disasters and pandemics. Unforeseen events. Major natural disasters or pandemics can create significant economic disruptions and market volatility, impacting various sectors depending on the nature and extent of the event. Factors influencing market movements. Economic data. GDP growth, employment rates, inflation. Central bank policies, interest rates, monetary policies, geopolitical events, wars, trades, tensions, political instability. Economic data paints a picture of overall health and direction of the economy. Investors use this information to gauge future business performance, consumer confidence, and potential risk. Positive indicators. Strong data on employment, GDP growth, or consumer spending can boost investor optimism, leading to increased buying and potentially pushing stock prices higher. Negative indicators. Weak data on job creation, slowing economic growth, or rising inflation can cause concerns about future profits and trigger risk aversion, potentially leading to market downturns. Market reacts based on expectations. The impact on data depends on whether it meets, exceeds, or falls short of analyst expectations. Surprises in either direction can lead to amplified market movements. Examples. Positive data. Strong job report. Exceeding job creation expectations may indicate strong economic growth and boost confidence in consumer spending, potentially leading to higher stock prices in retail, consumer staples, and discretionary sectors. Low inflation. Lower than expected inflation figures can ease concerns about rising costs and interest rates, potentially benefiting long-term growth stocks and bond prices. Negative data. Slowing GDP growth. Weaker than expected economic growth can raise concerns about corporate profits and investor sentiment, potentially leading to declines in broad market indices and sectors reliant on economic activity. Rising interest rates. Central bank decisions to raise interest rates can make borrowing more expensive for businesses and consumers, potentially triggering market downturns across various sectors. Central bank policies. Monetary policy. Central banks influence the money supply and cost of borrowing through tools like open market operations and reserve requirements. This indirectly impacts asset prices on economic activity. Interest rate adjustments. Raising rates makes borrowing more expensive, potentially slowing down economic growth and cooling down overheated markets, bull markets. Conversely, lowering rates stimulates borrowing and investment, potentially boosting economic activity and supporting rising markets. Communication and guidance. Central bank pronouncements and forecasts regarding future policy decisions can significantly impact investors' expectations and drive market movements. Interest rate changes and investor behavior. Higher interest rates encourage savings and attract investments to safer assets like bonds, potentially leading to decreased risk appetite and selling pressure in riskier assets like stocks. Lower rates makes borrowing cheaper, potentially boosting investments and risk-taking behavior, pushing prices of stocks and other prices higher. Investor anticipation. Changes in interest rate expectations even before actual adjustments can influence market trends as investors position themselves accordingly. Geopolitical events. Uncertainty and risk aversion. Geopolitical tensions, conflicts, or policy changes can introduce uncertainty into the market, prompting investors to become risk averse and seek safe havens like gold, bonds, or even defensive stocks. Supply chain disruptions. Trade wars, sanctions, or political instability can disrupt global supplies, impacting specific industries and commodities, leading to price fluctuations and potential market volatility. Energy market upheaval. Political events in major oil-producing regions can significantly affect global energy prices, with ripple effects across various sectors and potential consequences for inflation and economic growth. Investor confidence and sentiment. Overall geopolitical developments can influence investor confidence, leading to optimism, potential market rises, example, peace agreements, or pessimism and potential market downturns, example, military conflicts. Real-world examples. 2022, Russia-Ukraine war. The ongoing conflict triggered significant market volatility, with declines in global equities and rise in energy and commodity prices due to supply chain disruptions and investor risk aversion. 2018, U.S.-China trade war. The trade dispute between the two superpowers led to increased tariffs and disruptions in global trade, impacting specific industries like technology and agriculture, with market uncertainty and volatility. 2014, Arab Spring. Political instability and protests in several Middle Eastern countries led to oil price spikes due to concerns about supply disruptions, impacting energy markets and broader economic activity. 2016, Brexit referendum. The UK's vote to leave the European Union caused significant market turmoil due to uncertainty about future trade arrangements and economic implications, with the declines in British pound and broader market fluctuations. Strategies for different market phases. Bull markets. Focus on growth potential. Seek stocks in strong sectors like technology, healthcare, or consumer staples. Strategies to use. Invest for the long term. Consider increasing exposure to equities. Embrace active portfolio management. Examples: technology ETFs, blue chip growth stocks, growth-oriented mutual funds. Bear markets. Focus on risk management and downside protection. Prioritize income and capital preservation. Strategies: reduce equity exposure. Consider defensive assets like bonds, gold, utilities. Implement defensive portfolio strategies like stop loss or dollar cost averaging. Examples: high grade bonds, gold ETFs, dividend paying utility stocks, cash equivalents. In the correction phase, focus on strategic buying opportunities. Identify undervalued stocks with long-term potential. Strategies: rebalance portfolios if needed. Consider buying dips in strong companies experiencing temporary setbacks. Examples: Blue chip stocks temporarily down on profit taking. Undervalued stocks in promising sectors. Case study: 1998 to 2000 dot-com boom and bust. Bull market fueled by rise of the internet and tech companies. The S&P 500 tripled in value. Speculative buying and investor euphoria dominated. Influencing factors: low interest rates, technological advancements, positive economic indicators, and excitement about the internet potential. Crash: the bubble burst in 2000, triggered by overvaluation and profit taking, leading to a sharp decline in tech stocks and broader correction. 2001 to 2002, post 9/11 recession and recovery. Bear market: 9/11 attacks and economic uncertainty triggered recession and decline in stock prices. Influencing factors: geopolitical shock, economic slowdown, decreased business confidence, and risk aversion. Recovery: government stimulus, lower interest rates, and gradual economic recovery led to the market rebound. The Greenspan put in 2003 to 2007 and housing boom. Bull market: low interest rates and perceived central bank support. Greenspan put fueled a housing boom and broader market rally. Influencing factors: easy monetary policy, rising housing prices, strong corporate earnings, and investor optimism. Seeds of crisis: unsustainable mortgage practices and growing subprime debt created underlying risk later exposed by the financial crisis. 2008 to 2010, global financial crisis and aftermath. Bear market: the collapse of the housing market triggered a global financial crisis and severe market downturn, with the S&P 500 losing over 50%. Influencing factors: subprime mortgage crisis, bank failures, credit freeze, global recession, and widespread risk aversion. Recovery: government bailouts, quantitative easing, and gradual economic rebound led to a slow market recovery. Overall, this period highlighted the cyclical nature of the markets, the influence of major events, the tech boom, 9/11, financial crisis, and the impact of the economic policies on market trends. Future trends and considerations: green revolution, increased focus on renewable energy, clean technologies, and sustainable practices could drive growth in related sectors. Tech transformation, continued advancements in AI, automation, and digitalization could disrupt traditional industries and create new investment opportunities. Demographic shifts, aging populations, changing consumer preferences, and urbanization trends could impact various sectors like healthcare, consumer staples, and real estate. Geopolitical realignments, trade tensions, global alliances, and resource competition could influence energy markets, supply chains, and specific regional economies. Near-term market shapers, inflation and interest rates. Central bank actions can manage inflation and interest rates significantly, impacting borrowing costs, economic activity, and asset valuations. Geopolitical developments, ongoing conflicts, political instability, and diplomatic tensions could trigger market volatility and uncertainty. Corporate earnings and economic growth. The performance of business and overall economic growth will influence investor sentiment and stock market performance. Technological breakthroughs. Major innovations in sectors like healthcare, biotechnology, or space exploration could spark excitement and investment in those areas. We've explored the fascinating world of market cycles, delving into historical trends and the key factors that make the market dance. We saw how bull markets can soar on optimism and innovation, while bear markets can test the resilience with downturns and corrections. We've learned about crucial roles of economic indicators, central bank policies, and even global events in shaping market movements. Remember, understanding these cycles and the forces behind them empowers you to become a strategic and informed investor, navigating market shifts with confidence. Don't be a passive passenger. Equip yourself with the knowledge and make informed decisions based on your goals and risk tolerance. And hey, if you found this valuable, consider sharing it with others. Like, share, and subscribe to stay tuned for more insights in the ever-evolving world of finance. Together, let's navigate the market waves and make informed decisions toward a brighter financial future. Thanks again for watching.